Well, this is amazing. It's an AI-generated podcast talking about SPY T trading.
Ever feel like you're missing out on some secret market magic that happens while you sleep? Well, today's deep dive is all about unlocking that potential. We're going to take a look at overnight swing trading, guided by this fascinating source, spy-t-trading-v2.pdf.
Buckle up, because today we are diving deep. We're talking about the hidden potential of what's called the overnight market gap.
And that's where I think this whole idea of market pressure comes in. Because the source, they argue that it's not really about predicting the future, right?
No.
Who can do that?
Right.
It's like the author saying, look, what if you could have turned a modest investment into something truly significant just by focusing on this one window of opportunity?
Yeah, it really makes you think, and it gets to the heart of why overnight swing trading, specifically with the SPYT method, is so intriguing. You see, most traders, they're focused on that, daily grind. But what this approach argues is that the real opportunities, the potential for like outsized gains, often lie in what happens before the opening bell.
Okay, so let's unpack that a little bit. We're talking about the overnight gap, right?
Yeah.
So that jump or dip in price between the market close and the next day's open.
Yeah.
But it can't just be random.
Exactly. The SPYT approach is built on this idea of market pressure. Imagine like a pot of water about to boil. You can't see the bubbles yet, but you can feel the heat, that pressure building, right?
Yeah.
That's what the SPYT algorithm tries to do with the market, analyze various factors as the trading day closes to identify, potential upward or downward pressure building overnight.
So it's not about predicting specific news events, but rather like tapping into this underlying current, this this collective anticipation or reaction to information that's already out there.
Precisely. It's about, recognizing those signs, the subtle shifts in the market's temperature, if you will, that might hint at where things are headed. Now, before you run off to place your bets, it's crucial to understand that no algorithm, no matter how sophisticated, can achieve 100% accuracy, and the creator of SPYT emphasizes that repeatedly.
Right. The market's a wild beast. And that's why I was really curious about how SPYT addresses this whole unpredictability factor, especially with news and events unfolding overnight.
Yeah, instead of trying to predict the unpredictable, SPYT focuses on analyzing the closing pressure. The creator argues that often the way the market ends its day reflects a sort of collective wisdom, a hint of how traders are interpreting the information already in play.
Fascinating. So it's like we're reading between the lines of the closing bell. But how reliable are these hints? Like, how accurate has the SPYT algorithm actually been in predicting these overnight gaps?
That's a million-dollar question. Based on the data shared in the source, we're looking at an average success rate between like 72 and 76% over a significant number of trades, and that's just within the first 30 minutes of trading.
Wow, 72 to 76% consistently predicting the direction of the overnight gap. Okay,
Yeah.
That's impressive. But you mentioned the first 30 minutes being key. What's so special about that time frame?
Think of it this way. The moment that the market opens, it's like all those pent-up anticipations, reactions, and algorithms all collide, and it creates this surge of energy, a lot of volatility. SPYT aims to capitalize on that initial wave.
Okay, that makes sense. But you also use the word average when talking about accuracy. Does that mean there are times when SPYT is more or less reliable?
Absolutely. And this is where it gets even more interesting. The creator recognized that relying solely on an up or down signal just wouldn't be enough, especially given the unpredictable nature of, overnight news and events. So they introduced this concept called the probability number.
Ooh, I love when we add layers of analysis. Tell me more about this probability number. How does it work?
Think of it like a confidence level assigned to each up or down signal from the algorithm. A higher probability number suggests, a stronger signal based on historical analysis, meaning theoretically the prediction is more likely to be accurate.
So it's not just, hey, the market might go up, but more like, hey, based on these specific factors, there's a good chance the market will go up. That feels like incredibly valuable information to have.
Exactly. And this underscores a crucial point the creator emphasizes throughout this source. You are always in the driver's seat. The SPYT algorithm is a powerful tool, no doubt, but ultimately it's up to the trader to interpret the signals, manage their risk, and make, informed decisions.
So we're not talking about blindly following some magic formula. It's about using this tool, this insight into market pressure to potentially gain an edge.
Right. It's about understanding the potential opportunities hidden within those overnight hours and having a system to help you, analyze and navigate them.
Which brings us to, I think, the big question, what do you actually trade using these insights? We've mentioned options, ETFs. What are the different approaches and what are the risks involved?
Let's dive into those right after the break. We're back. And as promised, let's explore, the exciting world of what you can actually trade using these insights from SPYT.
Because knowing there might be an overnight gap is one thing, but knowing how to actually play it, I think, is where things get really interesting.
Exactly. And the beauty of this SPYT approach is that it's not a one-size-fits-all kind of deal. The source material outlines like a whole spectrum of trading approaches from conservative to, well, let's call it strategically aggressive.
Ooh, I like the sound of that.
Yeah.
So for the more cautious among us, where would we even start?
Well, at its core, the SPYT signal is about predicting the overall market direction, right? Not picking individual stocks or anything. So if the signal points to an upward overnight gap, you could keep it simple. Buy shares of SPY itself or a similar ETF before the market closes, aiming to sell when it opens higher.
Okay, so straightforward, easy to understand.
Yeah.
But you know me, I like to add a little spice to my trading life. What about those leveraged ETFs we hear so much about?
Now you're talking my language. Leveraged ETFs, TQQQ for a bullish bet on the Nasdaq, they can amplify your gains, but and here's the catch: they amplify your losses too. We're talking 2, 3, even 4 times the daily move of the underlying index.
Okay, so higher risk, higher potential reward. Yeah, that tracks.
Yes.
But I remember the source material mentioned something kind of interesting, that these leveraged ETFs could actually be less risky than some other overnight swing trading approaches. How does that work?
You're right. It seems counterintuitive at first, but it all comes down to avoiding this nasty little thing called IV crush that can really, really sting option traders, especially when the market gets volatile.
The dreaded IV crush. For anyone new to options, that might sound a bit like a metal band's name, but trust me, it is not nearly as fun. Can you break that down for us a little?
Absolutely. Imagine this. You're feeling bullish, right? So you buy a call option. Volatility is high, so options premiums, what you pay for that option, are up too because everyone's expecting this big move. You're feeling good. But then overnight, the unexpected happens. Maybe a surprisingly dovish Fed announcement or some geopolitical tension easing. Suddenly that expected volatility disappears.
And poof, there goes the premium you paid for that option, even if the market actually moved in the direction you predicted.
And it highlights why the SPYT creator really emphasizes understanding and monitoring volatility, especially implied volatility, or IV, as the cool kids call it. Think of IV as a forward-looking measure of how much the market thinks an asset's price will swing.
So it's like checking the weather forecast before you head out on a hike, right? You want to be prepared for those unexpected storms, just like we want to be prepared for those wild market swings.
That's a great analogy. The source material even uses this cool visual of an IV meter, almost like a fuel gauge for options trading, with the sweet spot being somewhere between 20 and 30.
Right. Too low, and you're not getting much bang for your buck. Too high, and you risk getting sideswiped by that IV crush. But this wouldn't be a deep dive if we shied away from the most, shall we say, engaging aspect of this strategy, options trading with SPYT.
Let's get into it. The source material dives deep into, how to tailor your auction strategies to your risk tolerance, to market conditions, and of course to those SPYT signals.
This is where things get a little more, complex, but also potentially way more rewarding. Options, just by their nature, they give you a way to, how do I explain this? Control a larger chunk of assets with a smaller upfront investment. Magnifies your gain.
More bang for your buck.
You got it. It's like, you're at the high stakes table now, but you haven't put down your entire life savings. It's like they say, with great power comes great responsibility, or in the case of options trading, with potentially great rewards comes the need for a solid strategy and nerves of steel.
Couldn't have said it better myself. The creator even offers this framework for making those strategic decisions, introducing this concept of a trade code.
Right. At first glance, these codes, they look a bit like a secret trader language.
Yeah.
But you assured me they're not that intimidating.
Not at all. Think of them as a shorthand way to break down your option strategy into, these manageable chunks. Let's take an example straight from the source. CIWM4C6. Each part of that tells us something, specific about the trade.
I'm ready to decode. What's the first clue?
The first letter, the C, tells us we're dealing with call options, meaning we're betting on the underlying asset to go up. Next, we have IWM, the specific ETF we're trading in this case, the iShares Russell 2000 ETF.
Okay, so we know we're bullish on the Russell 2000. What's next?
The 4, that represents our trade ratio. In this example, it's a 4.1 ratio. This could mean, buying 4 call options for every 1 put option, creating this bullish approach with a little downside protection kind of built in.
So even when we're feeling bullish, it's wise to have a bit of a safety net.
Wait, so you're betting both ways?
In a sense, yeah. It's a way to hedge, to potentially limit your losses if the market, decides to throw a curveball and move against you.
So even within the trade, there's risk management built in.
So much information packed into just a few characters. I love that you can essentially create this personalized trading strategy, like based on your own outlook, your own, risk tolerance.
Exactly. You can adjust that ratio, choose different options, select expiration dates that align with, how long you think that overnight pressure might last. It's like having this customized trading toolkit.
This has been incredibly insightful. But before we get too carried away with entries and ratios and volatility, we need to talk about the other side of the coin. The exit strategy.
Yeah.
After all, it's not just about getting in the game, it's about knowing when to cash in your chips. Hopefully for a profit.
You're absolutely right. And the source material really, really emphasizes that mastering your exits, it's crucial. It's often what separates, consistently profitable traders from those who, well, let's just say they learn some expensive lessons.
So how do we avoid becoming a cautionary tale? What exit strategies does the SPYT approach recommend for locking in those overnight gains?
Let's dive into those right after a quick break.
We're back and ready to tackle those exit strategies. Because as any seasoned trader will tell you, knowing when to get out of a trade, it's just as important as knowing when to get in.
Couldn't agree more. And the source material really, really drives this point home, emphasizing that mastering those exits. Well, it's often, the key difference, between those who consistently profit from overnight swing trading and those who, well, let's just say, end up with some interesting trading war stories.
Yeah, and those war stories usually involve some painful lessons learned. So let's talk about how to make sure we're on the winning side of those overnight swings. The simplest exit strategy seems to be, like the set it and forget it approach, right? Buy at the close, place your sell order for the open, and let the chips fall where they may.
Right. That's the classic overnight swing trading approach, aiming to capture that initial gap move and then, get out before the market has a chance to reverse course. It's a particularly effective strategy if you're trading with shorter term options contracts, where that time decay can really start to eat into your profits pretty quickly.
Right. Time is money, especially with options. But what about those of us who like to, ride the wave a little longer, potentially squeeze out, some extra profit if the momentum's in our favor?
That's where things get a bit more nuanced and where a good understanding of risk management becomes, essential. The source material talks about using trailing stops as a way to kind of let your winners run, but still, protect your downside.
Automatically selling when things start to turn south?
Precisely. But here's where your trading skills really come into play. You have to decide how tight or loose you want that trailing stop to be, right? Wow. Set it too tight and you risk getting stopped out of a potentially profitable trade, prematurely. Set it too loose and you might give back too much of your gains if the market reverses sharply.
It's all about finding that sweet spot, right?
Yeah.
Between maximizing profits but also managing that risk.
Exactly. And that's where understanding those market dynamics, like those support and resistance levels, even using other technical indicators, that can be incredibly valuable. It allows you to make more informed decisions about where to place those trailing stops.
Because even with the insights from SPYT, we can't forget that the market has a mind of its own.
Never underestimate the market's ability to surprise you. That's why having that, well-defined exit plan and sticking to it is so important in any trading strategy, but especially, I think, in the fast-paced world of overnight swings.
It's like that old saying, right? Plan the trade and trade the plan. But the source material also hinted at an even more advanced exit strategies, something about using day trading techniques to actively manage those overnight positions. That sounds a bit intense.
It definitely takes a certain type of trader. You
Mhm.
know, the author very carefully points out that this level of active management, it's not for everyone. It requires that deep understanding of market mechanics, the ability to read those intraday charts, and most importantly, the emotional discipline to make those quick unemotional decisions under pressure.
Right, not letting those emotions get the best of you. That's key in any trading, but even more so when you're actively managing positions. Sounds like the creator of SPYT has really thought through like all the angles here.
Yeah.
You know, providing guidance for a wide range of traders from,
Mhm.
beginners to those seasoned pros.
Absolutely. In fact, they lay out 5 distinct levels of overnight swing trading, starting with that super simple buy it close, sell it open approach, and progressing all the way to these complex strategies involving options ratios and hedging and even those day trading elements that we just discussed.
I love that they've created this framework for people to kind of assess,
Sure.
their own skills, their own risk tolerance,
Yeah.
and how much like time and energy they're willing to dedicate to this style of trading.
Because one size definitely does not fit all in the world of overnight swing trading, but no matter where you fall on that spectrum of trading styles, the key takeaway here is this: knowledge is power. You know, the more you understand about those market dynamics, about risk management, and the tools available to you, like those provided by SPYT, the better equipped you're going to be to navigate those potentially lucrative, those overnight swings.
I couldn't agree more, and that's what makes this deep dive so fascinating. It's not about blindly following some magic formula. It's about empowering ourselves with the knowledge and the tools to make more informed trading decisions. Regardless of our experience level.
Well said. And the creator ends on this very thought-provoking note, I think. They challenge us to consider what else is out there beyond the data, beyond the signals we've discussed that could further, enhance our overnight trading decisions. What other indicators, what other patterns or market insights, might we uncover to gain that extra edge?
No, that's a challenge I know our listeners will be eager to take on. It's a great reminder that the learning never stops, right?
Yeah.
In the world of trading, and there are always new discoveries to be made, new strategies to refine, and hopefully new profits to be earned. For the deep dive, I'm your host, signing off for now.